Welcome to the Disruptor Network podcast.
Hey guys, welcome back to another episode of the Disruptors Network podcast. Today we have an incredible guest, but also a dear friend to us that has successfully managed over 50 billion in mortgage transactions. He not only is extremely wise in the mortgage industry, but gives you the true insider tips for what's going on in today's market. So please join me in welcoming Frank Capobianco. See you guys in there.
Ignition. Liftoff.
Welcome back to the Disruptors Network podcast. I have a great guest today. So it's my friend and my business partner, full disclosure, Frank Capobianco, but he's also a brilliant mortgage mind. He's been in the business for, he does this like 17 years now, 16 years?
16
years. So I have Frank on, and Frank, thanks for coming. I know this is not your favorite thing to do in the world, but I appreciate you being here with me.
No problem. I appreciate you having me on. I'm usually, I have a face for radio, so video is a little uncomfortable for me, but welcome to the new world.
So the full disclosure, Frank's got a much bigger personality. He's much better at this than I am, but he doesn't choose to do any of it. So he's really kind of like the man behind the man. But what we really wanted to touch on today is going into 2022, real estate, mortgage. In 2021 and 2020, they were like very, very hot again, right? And 2022 is kind of the great unknown. So, I kind of wanted to touch on a few things with you. And Frank is, as far as business goes and mortgages, knows as much as anybody you're ever going to hear speak about it. So when he speaks about kind of where interest rates and stuff is going, it's still a guess, but it's a pretty educated guess. What do you think 2022 looks like for interest rates and inflation and real estate? I mean, what's your prediction on market?
Well, I mean, I do think that, some of the things that the fears that are out there with inflation in general and just, rates not being able to be held down artificially much longer are real. We see it a little bit right now. It's seasonality starting to break into the market nationwide. There is a migration of people from the Northeast and the Midwest moving down south to states with maybe a little bit better tax benefits, both real estate and income tax wise. Florida is a big one. The Carolinas, as you know, Texas is getting a lot of people in from California. But with that being said, the inflation targets and numbers just seem to keep going up, which eventually puts pressure on real interest rates and the mortgage market and real estate market itself. So we're seeing it a little bit. Rates are still good right now. I don't know how much longer that's going to last. In my opinion, we will start to raise slowly but surely. I don't think it's going to be violent. I hope it's not violent.
I mean, so I tell people all the time, and this is just my belief, and I could be 1,000% wrong about this, but I don't think we're ever going to see 6s and 7s again, because I don't think we live in a world that can withstand it at this point now, because we've changed the narrative, right? Like, it's like we've been 5% under for so long, or 6% under for so long, that how could you ever go back to a reality of a world that was different? I mean, do you look at it that way? Or do you think that that's a possibility that you could see rates shoot up that high?
Anything's possible. I mean, we've seen that, right? We never thought that we would be this low. So being that high, really, in the grand scheme of things, it sounds high now, but if you look back over time, that would probably be the average, 6-7%.
It is.
A lot of things would have to break in order for that to happen, though. So there would be some sort of, whether it's product offering or whether it's a different way of lending. I mean, in Europe, they have 50 and 100-year bonds. We're still kind of on the 30-year situation. I know back in the subprime days, they did some 40-year stuff. But if you think about it, if rates go up that high, only way that you could afford it is if earnings also go up that high, right? So if people start making more money, which they haven't, and that's kind of been the problem, you could afford it, or you could stretch the term out on these things, right? So now all of a sudden you got a 50 or 100-year loan, and I'm not sure Americans are ready for that, or that's the way we think. Europeans have been used to that for a while, or the values go down. And if the values go down, that creates an entire different problem,
Yeah. And that's the question, because I look back on history over the last 20 years, right? 2001, the internet bubble pops, the federal government steps in, they avoid inflation, they dump money into the market, they solve everything. 2007, 2008 happens, same thing. They come in, they bail out the banks, they put money in the market. COVID happens, same thing. They come in and put money in the market. So it's not like it, it's almost like the crashes that you saw in the 80s and the 90s and before, where they let the market crash and reset. They don't do that anymore, right? They kind of always step in and save us. So, I mean, what are your thoughts on that? Like, that's part of my, I guess, to add on to other questions. Do you ever think that the federal government's going to allow us to get to a place where homes are unaffordable because interest rates are too high?
Well, I hope not, and I don't think so, because real estate is really the backbone of the country right now. It's people's biggest asset and people's biggest liability at the same time, right? So most wealth for families is in the equity, hopefully in the home, whether it's 10, 15, 20, 50 years down the road. But also their biggest payment monthly and their biggest debt is a mortgage, right? So unless this whole trend of, hedge funds and large corporations stepping in, buying single family home and turning into a rental market, and the younger generation says, hey, I don't want to own anything, I just want to rent. If that plays true, which some people think it does, I personally don't, then we could see a whole different world and a whole different change, because you're dealing with business to business, right? It's big funds and big companies and large investors dealing with how to deal with rates and leverage versus average Joe homeowner. I believe that the American dream is homeownership and will continue to be homeownership. COVID threw a monkey wrench in that, obviously, and the younger generation's dealing with, again, unless they're home trading, cryptocurrencies, there's no way to generate enough income right now off of regular wages to really get into down payment money and into a home. So it's tough. I feel for the younger generation, but it will turn around. I think that new jobs are opening up. I think automation, technology, there's going to be a little bit of a lull in what jobs are available. But we're resilient, man. America's always finds a way, and we'll get there.
I mean, you said it though, like real estate still is the backbone, right? Like, so even for me as an investor, and same thing for you, like we try to be as diversified as we can, especially being in this business. So we're already very heavily leveraged in real estate, right? But when I look at the stuff I'm investing in, whether it's stocks or it's crypto or it's NFTs or it's trading cards or whatever we're invested in, right? Real estate still is the most secure asset that I have. And when I look around, and me and you have had this discussion in life, like, oh, I'm thinking about putting money here, or I'm thinking of putting money there, but like, I know that I can make this percentage on real estate, whether the market goes down or not. So, I mean, do you still foresee that being, like, in your brain, is that still the most solid investment for anybody who's looking to put money out there in the world?
Yeah, I think so, because you have a couple of advantages. I mean, first and foremost, it serves a purpose for both primary residence and investment, right? You need a roof over your head, and if you don't own it, you're going to pay somebody else to live in it for primary purposes. And in investment purposes, it's the same thing. Once you flip the script and you're the landlord, whether that be short-term Airbnb, VRBO, rental situations, or whether it be yearly leases. You're driving income that hopefully supports the house, or is close to supporting the house and the upkeep of the house to help you make the payments. And then on the other side of things, if inflation does come, well, the house that you bought for $200,000 is all of a sudden going to be worth $600,000, $700,000, $800,000, and the debt that once was 80% on that is almost inflated away. Because if the house is, when you talk about hyperinflation, which is crazy, but if the house goes from being 500,000 to 1.5 million because the dollar is worth less, your debt is still 300,000.
It's crazy, yeah.
So
that's a really good point. Nobody talks about that either. That's a really good point. Like, your asset actually will be affected in a good way by hyperinflation, if that ever were to happen. We don't think it's going to happen.
Well,
if that happens,
I don't know if it's necessarily good, because your buying power is less, right?
That's true.
But what it does is it pushes down your percentage of debt, right? Your debt doesn't go anywhere. You borrow 200,000, you borrow 2 million, whatever it is, that stays the same, and hopefully you're paying it down, which is why, and again, we have this conversation all the time, is like, borrowing money may not be such a bad thing for some people, for the right investors, right? Everybody always wants to pay their mortgage off and have no debt and live debt free. And that's great. And I'm one of those people. I do believe in that. I'm old school. But when you take a look at it and you take a look at some of the risks, like you said before, where to park your money, how to park your money. Well, if you have a house that's, paying for itself in rentals and paying for its own upkeep, and you're not over leveraged, right? You're not borrowing 105% of what the house is worth. But if you're borrowing 70 or 80% or 60% of what the house is worth, and we do think there's an inflationary period coming up, you know, that's becomes less and less important when the house goes up and the payments being made by the rental.
Yeah, you're right. And that's whole, and even in that, like, you see the stock market's up 30% and crypto's up 30, whatever it is, right? And even in real estate through short-term rental investments, and we've both seen it now, we have short-term rentals together, and we have, I'm getting, you see 25, 30% return on your money, 40, 50% return on your money. And short-term rentals are hard to do, Airbnb, VRBO, but those platforms are expanding. So I still feel like real estate to save is an investment, and I'm biased, obviously. But, other things that are affecting it, just to switch gears a little bit, are, all these shortages in supply chains, right? Like, so lumber, just even to get appliances, sometimes you have to wait 6-8 months. Like, do you continue to see that? Do you think that'll affect building over the next 2022, 2023, 2024, where builders are like, screw this, I'm not doing this right now because I can't put a timeline on it. It's too expensive. Does that affect the real estate market? Does that affect where our inventory is going, as far as we're already at a shortage right now?
Well, there's definitely a shortage. I mean, it's, you see it in places where there's not so much building going on, like up here in the Northeast. The house gets listed and there's, a line out the door. And then where you can build, where there's land, the builders are controlling everything. I mean, they'll tell you, if you don't want to buy this house, we have 30 people behind you that will. And they're all moving in from out of state. So they got a ton of money to throw down on down payments and whatnot.
Yeah.
I do think that the supply chain issues are going to get better. They are getting better. It's really just a matter of, are people willing to pay, and when does that demand slow down, right? Whether it's appliances have to do with the the global chip shortage, or lumber, and you can't get it from across the country. I think that they're coming up with solutions. Again, it may not happen in 6 months, maybe it's 60 days, maybe it's 6 months, maybe it's 2 years, but it's definitely going to loosen up. Right now, I think it's advantage seller, right? Because they can control it, but eventually that pendulum always does swing.
So it's just funny because, like, as you're talking, it's making me think that because there's a chip shortage and there's a supply shortage and there's a home shortage, right? All these things that people want, but there wasn't a feeding frenzy for cars. Like, you could always go out and get a car. It was something we took for granted, right? Now to go out and get a car, you're going to pay, over list, 30, 40% over list, because you can't get it because of the chip shortage. Is that like a strategic advantage almost? Like supply and demand? Like, as if now everybody wants these things because they can't have them.
Well, I think some of it may be by design. They'll never admit it, but it's definitely a different world than it was 2 years ago. But again, there's so much money in the market right now. Everybody's got all this disposable income. They'll pay $30,000 over sticker for a new Bronco, or Rivian that's didn't even get made yet. They'll put an order in on it. People just have a lot of money. So until that changes, there's really no reason for those guys to change it. And how does that affect real estate? It's the same thing. The builders aren't going to go out there and slow down, right? Because they're out there buying up land right now. They're putting up developments, and a lot of them are going to the situation where they'll tell you, and this is contractors or builders, ground up, or if you're doing rehabs, they'll say, look, here's my hourly rate, or here's my daily rate, or here's what I charge for the job. All the materials are on you. If you could, find them at a cheaper price, better, God bless, you buy them and I'll do it. And it's less risk for them. Some people look at the builders like they're gouging, but I know a lot of guys in construction, and they were hurt by that lumber a lot more than they were helped, lumber shortage. So I just think everyone's going to find a different way to do business. And the biggest driver is the disposable income still there? Are the wages going up? Are the people with money willing to spend it? In the beginning, there was a rush toward paying down debt and hoarding money, which is not what the government wants when they're trying to stimulate the economy, right? Yeah. They want you to go out and spend. So I think what happened was 2020, people paid off debt, they saved some money. 2021, people went on a little bit of a spending spree. I think that spending spree will continue into possibly the beginning of the year, first half of the year. but it's going to slow down. And when it slows down, it changes everything.
Yeah. Yeah. That's, a lot of, so we're starting to see, and people are starting to look at this as maybe cracks in the market right now. And Zillow's been a big story over the last couple of weeks that they exited this iBuying strategy they had. And it's funny because every single real estate agent posted it on every single social media platform. Like, so you saw it 100 times, right? They're the happiest people in the world. But two things, and I just want to get your opinion on it. First is that I don't know that it's necessarily a good thing, like, that they're exiting. I don't think that's a good thing. I think anytime there's properties in motion, even if they're buying it cash or they're buying it whatever, it doesn't matter. It's still creating value in the market. So I think that's always a good thing. And the second thing is that I don't think that it's as big of a loss as people are looking at it as, and I could be wrong, but like they were only in 2 or 3 markets, and maybe you know this better than I was. I think they were only in a couple of markets. I mean, how are you viewing them exiting and taking losses on some of these properties?
So, I mean, they were definitely being strategic about, where and how they bought. There was a viral TikTok that went out around there with a realtor that was kind of making the assumption, accusation, and whatever you want to call it, that they were manipulating the market. They would buy 10 houses at 100,000, and then the 11th house they would buy it at 150 in the same neighborhood, which inflates those other values. I don't know necessarily. I mean, they certainly could. I mean, they had the pockets to do it. They controlled these estimates as well as the sales. So I don't know that they were doing that or not. If they were, that would certainly short term help people, but long term hurt people because you're artificially inflating values. So if they were in fact doing that, then I think it does help that they're not here anymore. I don't believe though that was their business model. I think they truly thought they could get in efficiently and quickly buy houses because, as you know, that right now, if you go in all cash, right, versus someone that's trying to do an FHA loan or a 3% down loan or down payment assistance, the seller is going to side with the all cash offer, even if it's for less. And if you got a big corp like, Zillow that's coming in, the cash is there, the closing's king. So I think they were relying on that they can get in at a good price. They don't have to deal with realtors and commissions and all that kind of stuff. They probably thought that they could set up a distribution network large enough to get good competitive offers with construction people and rehab. And then they don't need a realtor to resell it because everyone goes to Zillow anyway. So in theory, it all works, but in reality, it's no different than, what Quicken's trying to do with Rocket. I mean, automating the real estate industry is not easy, whether that's the mortgage side or the real estate side. And I think that they felt that it's a long game. One of the things you got to give kudos to Rocket Mortgage too is they've been at it for quite a few years. They throw a lot of money at their tech. They throw a lot of money at their advertising. And you could ask people from the inside there, it's still not anywhere near where they want it to be. But it's a long game. Zillow, I don't think gave it enough time. And now they're out, which I agree with you, ultimately hurts a little bit because you want as many buyers on the market as possible, regardless of where they're coming from, because you don't want properties getting stale and going backwards. It's a domino effect. Yeah.
And I think you're right. I think that they were like, this isn't a long game we want to play, or this is a long game that we can't play because we don't know where the market's going or whatever. But we're obviously, so for those that don't know, Frank and I work with Cardinal Financial. We're very, very technology, focused for the next, foreseeeable future, that they're dumping a ton of money into tech. And we're essentially, when you really look at it, we're really more of a fintech company that operates in the mortgage space, right? So after being traditionally in mortgage for the last 20 years, we kind of chose a path that we thought where the future was. Do you see that the process, I know, again, being unbiased, right? Like industry wide, do you see that that's where the process is going? It's going more towards automation. Yeah, absolutely.
I mean, look at the leaders, look at the leaders in the space, right? UWM is number one with, by far and away in the wholesale world. And why? Because they made a streamlined, automated process that's easy for the independent channel, for the brokers to understand, close loans, get quick response times, whether it's purchases or refinances. They do a phenomenal job at that, and all the money that they make gets reinvested back into making that process even more efficient. We already touched on Rocket, which is more of a consumer direct strategy, right? Where you go straight from your phone app to the machine spits you back a rate, tells you what documents you need to send. and there's no interaction in between. Cardinal, which I believe is the leader in retail, where we are right now, that's the middle player, right? So we're investing in technology so that loan officers and agents can communicate quickly and efficiently with borrowers, to be able to rival and compete with those other guys, but from a retail perspective. So you got three leaders, right? You got Rocket on the consumer direct, UWM in the wholesale, and Cardinal in the retail world. And the differentiator is and always will be technology, because other than that, the bonds are the bonds, the rates are the rates. Same. Yeah. And if you can get your cost to produce down, right? How much it costs you to close a loan, how quickly and efficiently, how many people you need to touch that loan, that will eventually lead to, the fastest, the best rates, the cheapest prices, down to the consumer level. And that's how you win in the long run, and you do the volume and with the service that you need. I mean, the large banks have an advantage because they have billions and billions of dollars on the balance sheet. But talk to anybody that's ever tried to, buy a home with one of the larger banks, and it's like, they gave me a great rate or they gave me a great price, but I had to wait 172 days to get an answer on if I could do the loan or not, or the service just wasn't there because the tech's not there, and that's
it's an
not
impossible process. Yeah. And I think that almost. So it's funny being in the business all this time, and then when we have to do mortgages on our own, we almost dread it sometimes. We're just like, and it's not like an auto loan, like and you're borrowing a lot of money, so it makes sense. But it's also, I've always thought to myself, like, why can't the process be easier, right? Like, why isn't the process to get a home easier? And I know that we've been on calls with the CEO of this company recently, who's behind the tech, and he's essentially said that if you in the next 3 years, if you can't close a loan in less than like 10 days. He feels like that you're going to be out of pocket, right? I mean, it was something he said like that, right? Like that if we can't close that efficiency, we're going to be out of business.
Yeah, and I think, we're at that level already. There are other people that aren't, and they're trying to get there. And I think the problem is, tech has to go with culture, right? The culture has to really match the technology. You can't just put a machine in front of somebody and say, this is going to make your life better. You have to live it and breathe it, and it's changing every single day. You mentioned an auto loan. You mentioned, some other type of lending. I mean, there are really great companies out there that lend, but are fintech companies. I mean, look at SoFi. Is the easy example. You literally go on your phone, take a picture of your driver's license. Sometimes you don't even have to send the pay stub, and you can get money immediately. I think that what's going to happen in the real estate and the mortgage market is it's going to gravitate there. It takes a little longer, obviously, because you have to deal with title and whatnot. But, blockchain technology is going to penetrate the title insurance business. There's no doubt in my mind. We've spoken to people about it. It's designed perfectly for what for what the title insurance business is and whatnot. And once that happens, it'll start to creep into lending. May take years, but when it's there and it's efficient, it will make the entire process that much easier, that much more automated. For now, though, before any of that happens, things like, once again, automated underwriting and, instead of sending 15 pages of your W-2 and getting, of your 1040s and getting W-2s and pay stubs in and speaking to your CPA. I mean, we're seeing more and more the Fannie and Freddie automated engines allowing for maybe just one pay stub or maybe just a verification of employment from your employer.
Well, because all the information is out there, right? I think that's what people don't understand at this point now. Like, your income information is out there in the universe that we can, as a mortgage company, you can grab it. Your asset information is out there in the universe, so we can grab it. Like, all this information is there. So you would think if everybody buys in, including the customers, that we can really make the process a lot faster. And even for our purposes, I think that the mortgage business has always been a business that was long hours, long days. It was tedious, like month to month. Like, and I think even for us, because of the technology, our quality of life has actually gone up, where we're almost surprised at how smooth the process is compared to what it was, right? Like, I think in the last 3 years, at least our lives where we are technology-wise, the business has changed completely.
Oh, absolutely. I mean, you used to have to shepherd a loan through the entire system, right? You would literally walk. I mean, I'm old enough to remember paper files, but you would walk either the files or the problems desk to desk and say, can you help me disclose this one? Can you now help me lock this rate? Can you help me order this appraisal? And whether it was You know, whether it was a problem or whether it was just a typical process. I mean, that's how you move the loan. And again, we started with handwritten 1003s and paper files and 2-hole punch. And then you saw a big change when it went to paperless. Then you saw e-disclosures. I mean, we've already lived a lot of the change. And like with any other technology, I mean, you know, look at where cars went from, 1920 to 1970 was a big jump. But then from 1970 to now, I mean, forget about it, right? So think about where the next 5 years are going to bring you
you're right.
with those changes. And it's only going to be for the better for people in the business, for borrowers, for realtors, for the industry in general. And the cost to produce, I can't get it, through enough. Like, the easier and cheaper it becomes for originators and servicers to lend, the more accessible it is to the masses. So again, that will turn the tide. I mean, look at stock trading, right? You used to have to call Mortimer, at Duke and Duke so that he can buy a stock for you, orange juice futures. Then it went to E-Trade, which was still a little scary for people, but you could do it, at your computer. Well, Robinhood comes in, and whether you like them or not, they create this application where everybody and anybody with a cell phone and a bank account can now trade stocks, right? That's huge. That forced changes in the market that hadn't been done ever, right? So now all of a sudden there's free trades. Now all of a sudden everybody's doing, if you don't have an app on your phone, no one's, same thing's going to and is happening in the mortgage market. The more accessible it becomes, the easier it is to transact, the cheaper it is to do business. I don't know. I know we do container home loans and dome, like we do all these kind of crazy things that a lot of people don't know about. But if it was as easy as, clicking a button, searching for the loan that you want and the house that you want, and they even have 3D homes now. Who the hell knows where it's going to go? But it's all about accessibility, and you can't get there unless the cost to produce comes down. And the cost to produce doesn't come down unless you have automation.
Yeah, and it's for two things too. I think that for finances and borrowing money and lending money, whatever it is, I think now I'm in the business since 01. You're in the business for like 04 or 05?
04.
So me and you have both seen
just
really
in 01, I was still in high school, just so you know.
So we've literally seen 3 different businesses, right? Because from 01 to 07, it was one business. From 07 to really 2017, 2018, it was another business. And that from 2018 really till now, 2019 till now, it's a whole nother, it's really, we're in a different world, like
a whole different
world. For the better. It's all changed for the better, and I think real estate isn't changing as fast because you still need an agent to bring you out to the property to show it to you. And a lot of that hasn't changed yet. Do you see that changing at all? Do you see the realtors going away, or do you think that, like, how?
I mean, again, it really comes down to just how automated we're getting. I mean, you see everything in the news with the metaverse, and maybe we won't even buying real houses. We'll be buying fake ones. I mean, I have some fake land that I bought. But in the real world, you have things like Matterport, right? Where they go in and they do a full 3D scan. So if you can't make it to an open house, or the house is in a different state, instead of, trying to fly out to Florida and spend 2 weeks with your wife trying to, look for homes, you can now do legitimate 3D tours, both on the computer and with, Oculus goggles. I think all that stuff right now is a little bit of, I wouldn't say like taboo, but it's like, it's not as in your face. It's not as recognized as like a real solution. But we saw throughout 2020 and 2021, large investors and even, average Joes buying houses sight unseen. Right? Yeah. They would go in and they would bid sight unseen, especially if you're moving out of state. So some solutions to that with being a little bit more, user friendly on the virtual side, I think are definitely going to impact it. And I think it's not going to eliminate the agents, but it's going to change the way they do business. Yeah.
No, you're right. I mean, even for me, like, I think that I would say 50% of the properties I bought over the last 3 years were I didn't see them until after I was in contract, because I saw them over FaceTime, or I saw them over a video, or I saw them virtually, and then I made this. And the good part about it is all the information's out there, right? I can still get all the stats. I still know what the properties are worth in the area, and I can access it in like less than a minute. Like, so that's the stuff and I think for real estate investing in general, we're in a place where you really have all the information and just making the right decisions at this point now and not overspending. But like, you can move out of state and buy a house. You can buy something that's affordable because you can understand the economy someplace else. Whereas in the past, you would have to fly there, spend a month there driving around the neighborhood, like just to figure out what the hell was going on.
Well, even the economics, the economics are changing because of work from home, right?
Yeah.
You used to say, hey, we would hear it here all the time. In New York, people would move to Florida or the Carolinas when they needed to retire or downsize, right? But then you would always say like, well, a house costs 200,000 there, but your income goes from 80,000 to 30,000. So how does that affect you? It's not the case anymore. It's not the case anymore, right? Right now, I mean, everybody works from home, so you see my Cardinal background here, but I could be in Alaska. It doesn't. Nobody knows. Right. I mean, you're doing the same job. So that those economics are starting to move around a little bit. Those are going to pull values up in otherwise traditionally lower valued areas. I think it's going to pump money into economies. So think about it, not only from the real estate perspective, but you get this migration of, let's say, people from New York to South Carolina. And the typical house in South Carolina at the time, let's say, was worth $250, whereas the guy moving from New York, probably it was a $500,000 house. And the taxes up here were 10 grand, and down there they're 2 grand. So if you're moving down there, but your income's not changing because you have a work from home job or you're a crypto trader, Shiba Inu, you now have so much more disposable income to spend in the local market, right? So maybe you're buying other houses, maybe you're, spending money at local grocery stores, reinvesting, buying a commercial prop, whatever it is. Those underdeveloped areas are going to explode a lot quicker than they normally would have because you're importing the money from higher worth areas. So there's opportunity.
So shift of culture. Like shift of culture has changed everything. That being the case, what I'd like you to give people before I let you go is, what do you see for 2022? Like, what's your prediction on the market? Is it still a better time to buy a house because a $700,000 house at 3% is still better than a $500,000 house at 5%? Like, do you feel like money is still cheap, so now is the time to act? Like, what do you see for like the immediate future if somebody was listening to this, try to figure out what they wanted to do in the next 12 months?
You could listen, whether it's real estate, whether it's investing, stocks, whatever, you're never going to time the exact top or the exact bottom of a market. So it's all about your personal finances and goals. If you have to beg, borrow, and steal to get a down payment right now because you think you got to get in before all of a sudden, the house is too much money, I wouldn't advise to do it because, you have to always look at the other side, right? So if you just borrowed money from, against your inheritance and from your uncle and from a loan shark to get into the house, and God forbid the market moves against you now, that's when you're in that tough situation like the people were during the crash. On the flip side, if you've done all the right things and you've spoken to a loan officer and you've worked with a realtor, a financial planner, whatever, you have your money in order for your down payment. And I'm not saying you have to be rich, but if you need 3%, you have your 3%. That you raised and you have some assets in reserve and you qualify, then I think it's a good time to buy. I don't foresee wait 2 months and all of a sudden it's going to be better. That's not going to happen. What's going to evolve in this market? It's going to happen no matter what. And really it's up to you on the personal side of things to decide how much risk you want on the table. I don't think anybody should go out there and over leverage themselves, assuming that they're going to get rental. It's always, I see it, online all the time. Buy a 2-family, buy a 4-family. You always got rental coming in. You don't always have rental coming in.
No, you're right.
When the economy goes down and the market crashes and, there's a recession, you could be stuck with a tenant that's not paying or can't pay or is late. True. And it's putting undue pressure on you. Now, if you can afford the house without that, great, but don't go out there and buy 15 properties if you can't afford it. But everybody has done pretty well, or most people have done pretty well during these last couple of years. And if you have and you're ready, then I would say jump in and go for your goals. I mean, if your goal is to own a house to live in, primary residence, or whether it's a beach house or a second home or an investment property, you got to have a goal going in. If you failed to plan, you're planning to fail, right? That's what they say in sports all the time. So if you can execute on that plan, I do think it's still a good time. I do think rates are still good. Values can fluctuate. They always will fluctuate. But if you're in it for the long game, it's a blip on the radar. If you're trying to buy a house to sell tomorrow, then you really need to know the market. And that's a flip. That's not a long-term investment at that point.
Yeah. No, I think that's awesome advice. I think long-term that in my worst buys, I've outrun them, at some point, stuff that was worth 30 cents on the dollar, which I think will never happen again, still is worth more than I bought it for today. And was it a great investment? No, but I didn't lose. So I think that's really, really good advice.
And I think as far as the business goes in general, on the mortgage side and on the real estate side, people in the business, talking to agents right now and talking to loan officers, what we've seen, the evolution that we've seen, you used to be able to work hard and make money, right? You didn't necessarily have to be smart. And I don't mean, your IQ. I mean, sophisticated with technology and mortgage lending and product knowledge. You could just outwork everybody, right? You could just be a mule and just, climb the mountain. What we've seen now and where it's going more and more is if you're not working smart, it doesn't matter how hard you work, right? You're gonna get to a point where you just can't work any harder, and you're not going to be able to keep up with the people that are working smarter. So you always got to work hard and take pride, of course, but if you've been able to get by the last 20 years, 5 years, whatever it is that you've been in the business, just because you out muscle and out hustle everybody, I think that this industry is changing to the point where you can't anymore. And I'm a perfect example of that. I mean, I would take as much on as I could. I would train my guys the same way. But without the advances in technology, without the policies and procedures and scalability, it would be a much different existence right now than we're enjoying and seeing.
And take it from me, and knowing Frank really well and just knowing myself, like this is somebody who would run everything off spreadsheets for 24 hours a day and wouldn't stray from it. And now he's bought in technology, and because he's bought in technology, our businesses reap the benefits of it, right? Like, because if you use that hustle and that muscle and all that stuff, and you invest that time into learning systems better that actually can help you when you're not doing all the work yourself, like you've seen, we've seen our business grow tenfold because of it, because we've just, so I agree. I think this is like everything else that's going on through time, right? This is like Napster with the streaming services, and like, everybody fights technology, except when you buy into it, it's going to happen anyway. Same thing with, the iBuying, like with Zillow, it's going to happen at some point, but like, how long are you willing to wait for it to happen? But I don't think you can fight it either. Like, instead of trying to fight Zillow and fight Rocket and fight all these people, you're better off trying to work alongside of them with the technology. Like, you don't have to work with them, but try to move in the same direction, because it's going to happen at some point.
It has to happen.
It has to happen. Yeah, exactly. It has to happen.
It has to happen. This industry has been, especially in the Northeast, it's been lagging for so long. I mean, New York mortgage banking versus California mortgage banking are two completely different things, even in 2010, let alone 2021. So, from a national standpoint and from a local standpoint, the changes are coming, and they're coming rapidly. And before you can keep up with them, they're going to be here. And I think that, sales in general, real estate, mortgages and whatnot, sometimes people gravitate toward being, a big fish in a small pond, right? They like that because, whether it's ego or whether it's, that totalitarian, this is what I want done, this is how I want done, how I want it done, is a little bit easier. And that's the way they've been able to get through things. But being a big fish in a small pond in 2021, that pond's going to dry up. And you're not going to have anything to eat or swim in, right? And then I think that the next evolution is like, all right, well, then you want to be a shark, right? You want to be a shark in the ocean, and you want to be able to go out there and gobble everything up. And that's cool too. But the problem with that is you can only get so far alone. And I think one of the things that I learned here, when I came together with you, Ralph, and the others, and Tommy and whatnot, and Jimmy, and we just started really, really building a heavy squad. And we have some really heavy hitters in the retail side of things, loan officers, processors, managers, like an all-star team. And that's not easy to do in the sales business. But what happens is, instead of being individual sharks, you start to become the largest predator in the ocean, which is, a killer whale, right? But they hunt in pods. They don't hunt alone, right? So it's like, if you want to get to the true apex, you could think you're a great white shark and like you're, the biggest and baddest, or you're, some big fish in a small pond. But at the end of the day, when you hunt in packs, whether it's, lions or whether it's, killer whales, that's how you get it done, right? So why do anything different in business?
Yeah.
You got to be willing to put your ego aside a little bit, run in the lane that you're designated with. And that goes all the way up to the top. I mean, if I didn't think that ownership was investing in the right things with technology and balance sheet and products that were going to filter all the way down to our agents and borrowers, how could I tell my loan officers that it's the right thing to do? So
and you're right, and we're so bought in. You're right, like that you said, and everything you're saying is correct. But we were on a call yesterday with the CEO of the company, and he was talking about like industry things that come up every single day, right? Like things that are annoyances, what people are complaining about, more inside industry people. And you said something and you spoke up on a phone call with the CEO, with all the people in present, and said, if I just hope that we're not going to sacrifice any of the money we're investing in our culture and our technology for these things that have been problems forever. And I think that was a great message. And I think that's where he was going probably anyway, but he was trying to appease the people that were in the crowd.
I was going to say, I have some broken windows and some stones thrown at me for some other sales people.
But you're right. You ripped the Band-Aid off, and that was the truth. It's like, you have to invest in what's going to move the group forward, right? Like, and what's going to move the group forward for us right now and for most people is technology and culture. And like, as long as we keep putting money into that, everything else will fall into place. And the problems that were the problems will still maybe the problems will become smaller.
Yeah, and it's any business. I mean, look, culture is, you can't build a business without culture, and if you can't scale it, right? So you could be a hot dog sales guy and, run a one-man show, but when you can't sell any more hot dogs, you're not going to be able to hire anybody that wants to work with you because you're a jerk. So culture is paramount. That wraps in with the tech, like I said, being in you can go all the way back to the 1800s and talk about tech, or you could talk about what's going to happen in 2100 or whatever the hell it is, 100 years from now. There's always going to be some sort of a disruptor, right? And even if you're not the disruptor themselves, you got to be aware and prepared for that disruption. And I think that's where we are. We didn't invent mortgage automation, but we're certainly very interested in it, very aware of it, and pushing forward everything that we can to be cutting edge. And if we're not, we know what the heck is going on out there. You can't just bury your head in the sand and say, these are my realtors. They're never going to leave me. I work really hard. I've been doing business with them a long time. That stuff works until it doesn't.
No, and I think we've both been part of bad cultures, probably in places that we were doing a lot of business, but they weren't great cultures. And what happened for both of us in those systems is that you got to ceilings where you couldn't kind of get any further. So that was one. And the second thing I think is that you said something about egos before, and I think that's the most important thing. I think you have to humble yourself and put your egos aside, because once we were able to do that, financially we did a lot better. But people don't talk about that, right? Like, when we were able to humble ourselves and say, hey, I'm willing to not have my name on the marquee for the greater good of everybody else and for my greater financial good. And I think once we did that, nobody talks about that stuff because it doesn't fit people's persona. But when we really did that, we were able to really advance ourselves further than we could have if we didn't.
Well, you got to be secure, right? If you're giving up ego and you're letting down your defenses, you have to really be secure in who you're working with, right? Who your partners are, who your employers and employees are, and in yourself, right? So if you can do that and you can really scale and expand, then you're never going to look back as far as finance goes. I mean, I say it all the time, and it penetrates all the way down to the newest guy that started, to the branch managers, the manager, everything, all the way on up. And it's like, we don't worry about paychecks. We don't worry usually 99% of the time about, closing loans. We're talking about business, right? How do we make, guy X, 20% better than he was the month before? Or how do we, capitalize on this industry that we think is underserved? Those are the conversations that you go to instead of the day-to-day. We only made 3 widgets. We have to make 5, which we lived in that world. I mean, I lived in a world where, sometimes we had to close X amount of loans per week or else we couldn't make payroll the following week.
Yeah.
That's not that stifles your growth,
Yeah.
It teaches you things. Don't get me wrong. I'm only here because of the experiences that I have. And if you're living those things right now, don't think that, you're a bad person. You just got to take the outlook on, well, how the heck do I evolve from this? Right.
Yeah.
And look, there's something to be said about that too. I mean, when you make it too easy, I don't know, guys that start in November 2021 versus guys that started in November 2001 are going to have completely different experiences. But
For
I
sure.
think that lends back to having experience around you, having guys that you can trust that want to see you succeed, right? That have already lived that pain. I have plenty of stories for my guys and examples for all the guys around us and girls that, here's what not to do. I could tell you what to do, but I could probably tell you more of what not to do.
Not to do it, yeah.
And that only comes if you're working around good people.
I'm gonna leave everybody with that. Frank's not gonna give out his contact information, but I will. If you want to find him and ask him anything, LinkedIn's the best place for Frank. It's Frank Capobianco at LinkedIn, and it's Frank.Capobianco, CAPOBINCO at cardinalfinancial.com for his contact. If you have any questions, thanks for coming on. I know this isn't hard. I'm going to get you back on next month. We're going to start doing this because I think it's valuable. I think that people need to understand what's really going on with the market and not just the fluff they're seeing in people's ads. So thanks for doing this.
Well, no, I appreciate it, man. It was good. It wasn't as scary as some people might think it is. If you see me with an Instagram handle by next month, Ralph has won because I've held out this long. But maybe it's time for Frank Capo comes to Instagram.
It comes to it, yeah. Make some predictions for you people. He's great at doing it for us. I just don't put it out to the public. All right, bro.
All right, guys.
Later on.
Thanks, Ralphie.
And that wraps it up. I hope you guys enjoyed this episode with Frank Capobianco and learned as much as we did from his wisdom of being in the mortgage industry for 16 years. Make sure that you tune in to the rest of the content that we have and like and subscribe, and make sure you continue to follow everything because we do have Disruptors Network Season 2 coming up. So make sure that you tuned in and you're watching the journey. I'll see you guys next time.